Hi everyone, I'm Maddie and welcome back to Business Debunked. Let's go through a series of transactions together and decide which accounts are involved in each. That is, which accounts should we debit and which should we credit. Before we begin, recall that every business transaction must cause a company's accounting equation to remain balanced. That is, its assets must always equal its liabilities plus its shareholders' equity. We make journal entries to record the effect of a business event on the company's financial position. We record increases to our assets or decreases to our liabilities or shareholders' equity as debits. We record decreases to our assets or increases to our liabilities and shareholders' equity as credits. We can summarize this using the DED rule. We debit expenses, assets, and dividends. Increases to any other account are recorded as credits. And every journal entry must have an equal number of debits and credits so the accounting equation remains balanced. If you want more information on the fundamentals of debits and credits, make sure to go back and watch part 1 of this video, which is linked in the description. Let's get started. Let's say you decide to chase your dreams and start a company where you
insert pipe dream business idea here.
Say it out loud 3 times so you can actualize it into being, like Bloody Mary. Hey, maybe your dream business is to open a bar called the Bloody Mary. So now that it's for sure gonna happen, let's talk about how you can journalize your very first transactions. First, you invest $20,000 of your own savings into your dream pub to help get the business off the ground. The Bloody Mary's cash has increased, so we debit our cash for $20,000. What do we credit to keep this entry balanced? Well, this is also an increase to the contributed capital in the shareholders' equity section. You contributed $20,000 into the company, so we credit contributed capital for $20,000, which increases the shareholders' equity account by this amount. This $20,000 cash represents value or equity contributed by you, a company shareholder. We cover this topic of shareholders' equity in more detail in a later video, linked in the description. Next, you'll need to secure some extra funds. Maybe to start stocking up on expensive and exotic liqueurs. So you ask your mom for a $30,000 loan. You have an obligation to pay this amount back, so the company's liabilities have increased by $30,000. This is a credit to our notes payable. Your mom hands over $30,000 to the Bloody Mary, so its cash has also increased, so we'll debit cash for $30,000. Next, you find a sweet location right in the heart of downtown. You sign a lease agreeing to pay $2,000 in cash at the end of each month. After the first month, you pay your rent and record a credit to cash for $2,000. This is an expense. Since we have already used up the value of this rent, we debit rent expense for $2,000. This decrease in cash represents a decrease in net earnings, lowering the company's retained earnings and therefore its shareholders' equity. Recall the DED rule. We debit expenses, assets, and dividends. Now you decide to buy some merchandise to sell. Your Uncle Gordo gives you 1,000 beer mugs with Mary's face on them in exchange for $5,000. Instead of paying him right away, you promise to pay later. This future obligation to pay is a liability because you now owe your Uncle Gordo $5,000. You credit an increase in your accounts payable for $5,000. You also debit a $5,000 increase to your inventory. These mugs are assets, since you'll derive future value from them by selling them. Finally, after a year of hard work, you decide you've earned enough money to pay yourself some money back in the form of a $1,000 dividend. In this case, you're paying out cash, decreasing the company's assets. So we credit cash for $1,000. Dividends are paid out of the company's net income that has been accumulated over time in retained earnings. It represents value that the firm has created over the life of the business that belongs to the owners and can be paid out to them. When we pay dividends, we're decreasing the amount of money that is being kept in the firm, or the value that's left in retained earnings. So we debit dividends for $1,000. Remember the DED rule. We debit increases to expenses, assets, and dividends. Another way to get this $1,000 to you would be for the Bloody Mary to pay you a salary or a bonus. In this case, instead of debiting our dividends, we would debit our expenses. Both options ultimately reduce our retained earnings and therefore our shareholders' equity. But expenses reduce our net income, while dividends do not. Since companies pay tax on their net income, this may have tax consequences. Note that even though you're the sole shareholder of this company, the company is a legally separate entity. So when it pays out cash to you, this cash is gone from the company. It's no longer one of the company's assets. The Bloody Mary's retained earnings have decreased by this amount, since this amount represents value belonging to the shareholders that has been paid out to the shareholders. Sometimes one transaction will affect more than two accounts. We just have to make sure that in total, the debits always equal the credits. Next, maybe you decide to start making your own Bloody Mary drink mix. So you buy a machine that costs $25,000. You work out a deal where you pay $15,000 up front, and you'll repay the rest in yearly installments over the next 5 years. So we debit a $25,000 increase in our assets for this machine. And we must pay $15,000 in cash, so we credit cash for $15,000. So far, this entry doesn't balance. That's because we also need to account for the $10,000 liability we must repay on this machine. So we credit our notes payable for $10,000, causing our debits to equal our credits and balance out. Over the next 5 years, as you pay off the $10,000 that you owe, you'll credit your cash, as you have to pay back in cash, and debit your notes payable, as your liabilities will be decreasing as you repay this loan. Notice that in this journal entry, it doesn't matter which credit entry is listed first, as long as you get in the habit of listing all of your debits before your credits. So those are a few of the ways that business events can affect our company accounts. We record these transactions using a double entry accounting system of debits and credits. We record increases to our assets as debits and increases to our liabilities and shareholders' equity as credits. No matter how many accounts are involved, every journal entry must have an equal number of debits and credits so our accounting equation remains in balance. Remember the advice that my grandma gave me when I got my first pimple today. A company's assets must equal its liabilities plus its shareholders' equity. Thanks for watching, and we'll see you next time. Insert pipe dream business idea here. No. Insert pipe dream business idea here.